think we know what that number is, a sort of ratio of debt to GDP, where it would be a problem. There are, of course, Japan being a great example. There are countries that have much higher levels of sovereign debt to their GDP than we do. What's clear is that our debt is growing much faster. The federal government debt is growing substantially faster than our economy, and that ratio is going up. And, in the long run, that's kind of the definition of unsustainable. The level of the debt is not unsustainable, but the path is not sustainable. And so it's really important that we get back to, we don't have to pay the debt down. We just need to have, primary balance and begin to have the economy actually growing better, growing more quickly than the economy. It will not end well if we don't do something fairly soon. This is not the Fed's job. Of course, I'm well aware, and my colleagues too are well aware of the current situation for students coming out. It's a time of very low job creation. And also you have AI going on. You've got the effects on job creation of significant changes in immigration policy, which have brought down both demand and supply of workers. The unemployment rate is really low, but that doesn't help you if you're coming into that kind of market. So it's a time when the business, there's a business cycle, right? And you're coming out in the business cycle at a time when getting hired is a little bit challenging. There's also probably something more longer term, more secular that's happening and around technology and AI. So yes, it is a challenging time, but I'll say a couple things. One just is that the U.S. economy, compared to other major open economies and big market-based economies around the world, is just incredibly dynamic and productive. Since World War II, U.S., compared to other, again, large, mature economies, our productivity has grown at like twice the speed, for example, in Europe, and higher productivity is the way, compensation and earnings can grow over time. So it's an incredibly flexible and dynamic economy. It reinvents itself. Technology, it always comes from the United States. So just be optimistic about the medium and longer term. I'm very optimistic about the medium and longer term. And the other thing is, my observation is that these large language models make people much more productive. I feel like it's making me more productive because I can learn things really quickly. And I talk to my son and others who are out there in the world, and I think if you use it well, it's making you more productive. So I think you're in a situation where you need to invest the time to really master the use of these new technologies, and that should stand you in good stead. But there's no denying it's a challenging time to enter the labor market, but it may take some patience and all that. But
to at least retroactively say that what we really needed during the COVID pandemic was around $3 trillion. And the government printed, something along $6 trillion more than that. And so inflation rose, but that money is still out there. So if rates come down, obviously you took initiative and you raised them very significantly. If rates get lowered again to, let's say, 2% or so, do you think that the price spikes have already played out? Or do you think that all that extra money being out there will, on top of, instability, geopolitically, do you think that's going to push us back into an inflationary spiral? And then also I was wondering, for your next press conference, are you going to start it with good afternoon or hello, everyone?
Let's talk about that later. Sorry, the first question was
the expansion of the money supply.
Yeah, no, so I think monetary quantities are a very challenging way to try to think about inflation and the economy. There was a time when the profession thought that, monetary quantities and inflation were tightly linked. And of course, in an abstract way or in a simple model, it makes sense. If you don't increase the amount of goods and you double the amount of money, then the price has to go up. But there has been relatively little correlation. And, my story of the pandemic inflation would not be about monetary quantities mainly. I'm not saying it might not have played a role. It was more, you did have a lot of stimulus, particularly in the United States. At the same time, we were looking at the possibility of another Great Depression. We didn't know whether there would ever be a vaccine. We didn't know what this was going to be. How many millions of people was the disease going to kill? So literally, for the first time probably ever, we're looking at little alternative simulations that are a Great Depression lasting many years. So we did a lot of stimulus. And then when the global economy reopened after shutting down, you had this burst of demand, red hot demand, and constrained supply still.
And then again in 2020, under your leadership, there was a second vast expansion in the Fed's balance sheet to address these two economic and financial crises. The balance sheet has since come down a bit, but it still sits at over $6 trillion. So I'd like to hear your views on how efficacious this vast bond buying program has been, both in the 2008 and then again in the 2020 episode, and also hear your reaction to the critics who say that the Fed has become too big a player in the bond market. The Fed has become too influential. There's been a muddying of, as according to the critics, of monetary policy and fiscal policy. Do they have a point, or are they wrong?
So I think the place to start with that is the problem that people were struggling with from about 2008 to 2022, let's say, in central banking everywhere in the world is once you've cut interest rates to zero, do you have anything else you can do? Let's say you cut interest rates to zero and the economy is still clearly not flourishing and it wants more support. So do you just say, well, we're done, we're out of ideas here? And there were two ideas that were followed in the global financial crisis, one of which was to buy assets, longer-term assets. And what you're doing there is you're buying longer-term government-guaranteed securities, which would hold down longer-term rates, and that should stimulate the economy. Or also forward guidance, which would tend to hold down forward rates as well, or just rates generally. So we did those two things rather than do nothing. And I think in the first instance, they were both efforts were successful at restoring market function and at restoring financial stability. At the beginning of the global financial crisis and the pandemic, we had massive problems of market function. They were solved. I think the question, getting to your question, David, of the macroeconomic effects is a much less certain question. I don't think there is an accepted answer, but I would just say there's an oceanic quantity of research on this, and overall it tends to find that buying long-term assets does lower interest rates and does provide some support for economic activity. And I guess I'd be in the camp of thinking that there's something in that, but it's hard to quantify it. And I think different people have different views on how much those effects could be. The other side of it is, QE is thought by the critics to risk all kinds of other things. So, for example, you could buy too much of the Treasury market and it would stop functioning well. We have not seen that here. At the very beginning, there was the thought that it would be inflationary. We have not seen that, or that it would threaten financial stability or even create inequality. So we haven't really seen the downside risks. At the same time, the last thing I'll say is, I remember before I took over as chair thinking I'll almost certainly never have to do quantitative easing. So what's that expression? Man plans and God laughs, something like that. So it just, the pandemic came around and we needed to do a lot of asset purchases in a big hurry, and we did. So far, no Treasury Department has ever said, stop doing that, you're supporting the economy too much. Maybe that'll happen someday, but it hasn't happened yet.
Welcome to the Crypto Teacher. And I come back with that video just to make you think. And make sure you go join the Patreons, so therefore you keep up with all the NWO events. And right now we can clearly see we're in a crisis. And if you're not a part of the Patreons, make sure you're donating to the channel through the Cash App. And then also go like and follow the TikTok, more videos to come. And I want you to stop, like this channel, share it everywhere, and subscribe. And remember, the Crypto Teacher told you. And we had Jerome in the house today, speaking at Harvard. And he was asked about all this debt, and he says his debt is not sustainable. But remember, guys, he said that about 4 years ago. And we keep piling it on. And don't forget they printed 80% of all money in existence within 2 years. And he was asked about all that money printing. Said that we only needed about $3 trillion, but the Fed printed 6 more. And where did that money go to? That's right, to all the big tech, all the big corporations for the fourth industrial revolution. And the people paid for it due to inflation. And you're talking about global inflation. And don't forget what Scott Bessent stated. They're going to be turning the machines on in the second quarter. That means productivity is going to go up. But guess what? Humanity is going to be going home. And unfortunately, all these kids that are in college, getting all these degrees, they're not even going to be able to use them. And that's the reason why it's so important to get back to the creator, so therefore you can start creating. We haven't seen all the things that these machines can do. And don't forget, these machines are eventually going to get brains. These machines are going to eventually have quantum computing, which nobody can see right now. And a person brought up the Fed's large language model it has for itself. And we know the Fed has been running simulations from the beginning. Same way how BlackRock took over. Guys, they use these bots. And we know once they finish using them, they're going to hand them off to you because they got something much greater sitting behind the curtain. And remember, the crypto teacher told you. And Jerome Powell is asked about that 2%. But don't forget, he already told us that we wouldn't get back to that 2% until 2028 because he knows the machines are going to drive down inflation. It's just going to take a while for them to get into the system. And no one's talking about tariffs because we have all the distractions. We know that's going to raise inflation. The only reason why inflation has been down right now is due to oil prices. Now oil prices have moved up. And of course, that's going to increase inflation. And we know the only person that gets hurt, that's right, is the consumers. But remember, we're in a fragmented world. They have to break up everything in order to bring in this fourth industrial revolution. Remember, they don't want you to own anything, but they want you to be happy. And remember, the crypto teacher told you. And we have Trump on the Strait of Hormuz saying that he has a deal 1 minute. Then Iran come back and say, no deal. So we see the drums are beating, getting louder. I do think the drums are beating are going to get quiet in May. But then all of a sudden it's going to turn cyber. I do see us having a lot of casualties in April. And then they turn over to the machines in May. And going forward, we're just going to start seeing strange things happen. Remember, we're going to be living a real Star Wars movie. And remember, the crypto teacher told you. Because he knows, when it comes to the NWO, it's all planned out. Y'all have a wonderful day.
The FOMC is and will continue to be committed to getting inflation back to 2% on a sustained basis. That's the place to start. So I feel like we had pretty much gotten there at the end of 2024 against the predictions of almost the entire economics profession. When we raised rates a lot and very quickly in 2022, 100% essentially of economists were forecasting a recession. We didn't have one. Actually, we had 23 and 24 were both very strong years as the supply side healed and as our higher rates had some effect on inflation. So by 2024, you had the economy growing at 2.5%. You had inflation in the 2 plus a few tenths on a 12-month basis by the end of the year. And you had the employment market. You still had the labor market at essentially full employment. So I would call that a soft landing. We had it there. Then since then, we've had to face a much smaller source of inflation, which is the tariff inflation is visible, and we think it's really just a one-time price increase. That's been our thinking since the beginning. Right now, we think it's adding somewhere between 0.5 and a full percentage point to inflation, but that's a much smaller thing than we saw during the pandemic inflation. And and of course now we're facing events in the Middle East which will certainly affect gas prices, and we feel like our policy is in a good place for us to wait and see how that turns out. Quite a bit, and as I mentioned, we're watching very carefully. Of course, what you can read in public. We're also getting the backstory from the people who run these organizations and from all the banks. The supervisors are well aware of what the bank's exposure is and what is not. And I'm reluctant to say anything that suggests that we're dismissive of the risk, but we're looking for connections to the banking system and things that might, result in contagion. We don't see those right now. What we see is, a correction going on, and certainly there'll be people losing money and things like that. But it doesn't seem to have the makings of a broader systemic event. But again, we never give a clean bill of health. We just keep watching for that. We don't see those characteristics though right now.
Remember, not so much what the president says, but what he does. And what has changed over the course of the last week is now we have Marines in the region who receives more rain and snow than any of its neighbors. That's why South Africa signed a water-sharing treaty with Lesotho in the late 1980s. The deal meant Lesotho would sell its water, while South Africa would ensure the supply of this vital resource. Just about 7 hours south of Johannesburg sits the Katsi Dam behind me. Now about 30 years old, it is the first model for the water-sharing agreement between Lesotho and South Africa. As South Africa's water needs grow, a second dam is rising east of Katsi. The Purihadi Dam will be nearly 20% larger and is being built higher in the mountains to capture more runoff. Today, around 60% of South Africa's capital, Johannesburg, gets its water from Lesotho, earning the Mountain Kingdom about $300 million a year in royalties.
The level of complacency is astounding. Why is this so bad? What are we missing?
Well, I think what the market is missing is the West is really yet to feel the true impact. When you read stories about product hoarding, you read about operators of gas stations being shot dead because they ran out of product in India and was unable to fill up cars. You hear about fishing boats in the East not being able to fill up because the economics of going out and fishing just don't make any sense. We see the world through a Western lens, and yet this is a global crisis. When you think about the true impact, like the Strait of Hormuz, people may say this now, but no sober mind ever thought that it could ever actually be impeded because it was just too critically important. Roughly 22 million barrels per day of oil and product were flowing prior, which is obviously massive from a global context for oil. We know LNG, 20% of global flows as well. And so when you consider that global oil production today is down about 11 million barrels per day, it's forecasted that between barrels already lost and those yet to be lost, we will lose about 900 million barrels of Middle Eastern production this year. Contrast that to COVID, the biggest demand shock in history, and demand fell about 870, 880 million barrels. So it just puts things into perspective, and yet the market remains very, very complacent, both on the near-term impact and also the long-term impact of it.
The average consumer or to the markets, maybe.
Right, but so the question is in absolute terms. I think there's no doubt that we are going to have not just an energy price shock. In my mind, we're going to have an inflation shock. Secondly, we are likely to see that inflation shock translate into less spending, particularly for the lower-income households. So there will be a demand effect. If this continues, so you start with energy shock, interest rate shock, broader inflation shock, demand shock, then if this continues, which I hope it won't, we're going to be talking about financial instability. So that's the sequence. Hopefully we don't go all the way down, but that's the sequence that's been triggered by this war.
Even if the war would end tomorrow, from what I've been reading, the damage to the infrastructure in that region is significant. So you have natural gas plants that won't be online for another 5 years. Yeah, and I also think, even if the war were to end tomorrow, the cost of moving through the strait is going to be up meaningfully, either from an insurance or shipping perspective. So in that way, Joe, I think this is, I don't think it's fatal, to the market, but I do think that this will last longer, and it's going to raise the cost of capital because we're going to have to issue a lot more debt, and people are going to have to, I think people are tightening up their credit standards.
We're going to have tremendous workforce availability. We're also going to have robots helping us. We're going to have a lot of robots helping us because we need it. And because we're going to town, we're building a lot between the AI and the auto plants. So we're going to need robots. We're going to have robots, but that's going to help us.
Robots hold steady hands in the operating room, and drones are redefining the future of war. Innovations of first-generation humanoids, factory automation, and autonomous vehicles have surged from private sector investment. Every one of these advancements is powered by AI. The robots are here. Our future is no longer science fiction.
Maybe crypto is actually built for the machines and we didn't even know it. And AI can easily handle private keys and easily understands transaction hashes and like how all this stuff works. It is money that is built for computers, even before the computers to intelligently handle it were built. So I find that interesting. And perhaps those of us who were involved in crypto pre-AI were kind of just like getting the ground ready for the AI systems to have a fully developed financial system handed to them, for better or worse.
This could be perhaps the greatest revolution in financial technology since the birth of the internet itself. Many Americans are unaware that behind the scenes, the technical backbone of the financial system is decades out of date, many, many years out of date. You know that. Paul and others are straightening it out, but payments and money transfers are costly and take days or even weeks to clear. Under this bill, the entire ancient system will be eligible for a 21st century upgrade using the state-of-the-art crypto technology.
And as President Trump has directed, we are going to keep the U.S. the dominant reserve currency in the world, and we will use stable coins to do that.
I think stable coins could reinforce dollar supremacy, because with stable coins could end up being one of the largest buyers of U.S. treasuries or T-bills. Mm-hmm. So all of a sudden, if you are using a stable coin in Nigeria that's backed by the U.S. dollar, you don't actually have to have dollars. It's on your phone. You can transact.
We are going big on digital assets. So Trump administration has made digital assets a priority. I've seen estimates that just over the short term, stable coins could create $2 trillion of demand for U.S. treasuries and treasury bills. To put that in context, the number is probably about $300 billion right now.
We will take a close look at regulatory impediments to blockchain, stable coins, and new payment systems.
The Department of Commerce is going to start issuing its statistics on the blockchain, because you are the crypto president, and we are going to put out GDP on the blockchain so people can use the blockchain for data distribution, and then we're going to make that available to the entire government so all of you can do it. We're just ironing out all the details so we can do it.
Together, these world-leading technology giants are announcing the formation of Stargate. So put that name down in your books, because I think you're going to reduce the cost of virtually all goods and services. It'll make the United States a manufacturing superpower and the world capital of artificial intelligence and crypto. But with today's announcement, we take a major step to bring healthcare into the digital age. Instead of filling out the same tedious paperwork at every medical appointment, patients will simply be able to grant their doctors access to their records at the push of a button. Just a button and you're all set, and all the information the doctor needs will be immediately transmitted.
Going to a different economy, and we're going to be learning more about that as we go. But clearly, we're learning that things can be done from remote locations. We're learning that technology can replace people even more than we thought.
We're not going back to the same economy. We're recovering, but to a different economy, and it'll be one that is more leveraged to technology. And I worry that that is going to make it even more difficult than it was for many workers.
In Silicon Valley, and my friends who work in technology know that what we did to the manufacturing workers, we are now going to do to the retail workers, the call center workers, the fast food workers, the truck drivers, and then even bookkeepers, accountants, insurance, agents, lawyers, and on through the economy. So what happened to the manufacturing workers is a very clear sign.
And so we'll import Chinese-based CBDC technology. So it's going to be CBDC in a box provided to you by the People's Bank of China.
But every stock, every bond, every currency, every commodity, every piece of art, every private business, every piece of real estate will eventually be a token on a blockchain, an entry on a ledger, permanent and immutable. We will have truth instead of trust, and we will save over $7 trillion a year.
Like what you see in China and their social credit scoring systems, right? If we get identity wrong, it could be a tool to enslave humanity. And if we get it right, it could be a tool to liberate humanity. And as an American, I'm obviously rooting for the one that's on the side of freedom.
If we could tokenize all our ETFs, all $5.3 trillion of our ETFs, and provide that in a digital wallet, you could seamlessly, without fees, going from a digital currency or a stable coin or whatever that may be in your digital wallet and buy bond or stocks. And I believe that is going to be the future.
I believe we're going to be in the cutting edge of tokenizing bonds and stocks. It's coming. And we have the technology now. The fact that we are now moving forward in tokenization, every bond and stock, is crazy. Yeah. We should be moving towards that frontier. Obviously, there's winners and losers and all that, but we need to be prepared for the tokenization. And it would democratize more finance if we tokenized bonds and stocks.
Cryptoteacher and the New World Order book, plus the 3 kids books. It's time to re-educate. Also, new to cryptos, Coinbase, Bitrue, Binance. Do not forget book links and crypto links are in the description. The stock channel, guys. Don't forget to go like, subscribe, spread everywhere. You have your Kobo, your chip stocks, your banking, your gaming. While everybody's sitting at home, get on stocks, the Seaver, the biotech stocks. And while everybody's at home wishing, they were still getting that free money. What are they doing? Drinking and smoking weed. Don't forget about those stocks, and you have a wonderful day. The most powerful person in the world is the storyteller. The storyteller sets the vision, values, and agenda of an entire generation to come. Steve Jobs. And guys, I truly believe in this. When you look at the New World Order, they're the storytellers. And that's the reason why I wrote my New World Order book. But guys, now it's time to change the current generation. And I wrote 3 kids books. I love the Trinity because I understand the power that's in it. So I have 3 books. We have an opportunity to change the generation, to educate, not just me, but I want to show you that I take action on a daily basis. And I want you to take action on a daily basis. Whether it's your job, whether it's in your community, we have an opportunity right now to educate the masses. I posted this on my Twitter account. Please share, but this is a short clip of the 3 books. There's going to be a clothing line and action figures. Please get these books for your kids, nephews, cousins, friends, so therefore we can start the re-education now. Because as we see, the 4th Industrial Revolution foundation is definitely here. Robots, algorithms, drones, taking humanity out the picture. We have to re-educate. But let's get into the video.
Part 1. King Joshua and Drama Team Save the Village. Part 2. King Joshua and Drama Team Save New York from COVID-33. Part 3. King Joshua and Drama Team goes to China.
It's mandatory to get part 1, part 2, and part 3 of this series. It's time to re-educate Generation Z.